Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, August 25th, 2021. I'm going to start this video out covering just a few of the trades that stand out to me right now, is swing and or trend trades. And I'm going to spend the bulk of this video covering various breadth indicators, and they're all pretty much telling me the same thing right now. So I think those are important developments, or at least worth monitoring. Again, breadth indicators will give you the condition of the market. They're not hard buy and sell signals, but again, it's pretty impressive what I'm seeing there right now. So I'm going to get to those in just a second, and I'm just going to take this opportunity in the beginning of the video to tell you what I like at this point in time. Still liking gold. Gold's down today. That's why I'm highlighting it right now. I think it's a buy right here. It's down. These are gold futures down 1.2% right now, coming up on pretty darn good support right here. I have a support zone roughly about 1777 right here. I will acknowledge it just put in a divergent high, negative divergence, and that could play out for more. But I think we're on the verge of a breakout in the euro right now, and the dollar has already started to roll over. So let's look at that real quick. And again, I spent a lot of time yesterday, and I always talk on how the currencies are going to dictate where gold goes to a very large extent. So looking at the dollar, here's the U.S. dollar futures DX, and recently put in this divergent high right here. Divergence has been building since all the way back at this point. These indicators making higher highs, or the prices, making higher highs in the dollar index, and then the indicators making lower highs. That's your negative divergence. And then had this little wedge breakdown there, led to this impulsive drop. And then we recently took out this minor downtrend line. We've been back testing from below after hitting this support 92.8, about 92.81, give or take. And so that needs to get taken out. And based on the technical posture, I believe it will. So I think we're going to see considerable more downside in the dollar. Remember, we need to break that support. I talk about setups versus actionable trades. There's a big difference. This is the euro right now. This is the trend line we need to take out. E7 or euro futures. This is a 60-minute chart. There's your trend line. There's your divergence line right there. Positive divergence is building. So we pop that. We should have a nice rally in the euro, which will almost certainly coincide with a rally in gold because of the fact they're positively correlated. Excuse me. Now let's look at if you don't trade, if you don't track the futures, you don't have futures charts, you can look at FXE for the euro, and this is what the 60-minute chart looks like. You know what? Let me do euro US dollar. I had that one marked up already for you. There we go. That's again the primary downtrend line right there, which is close. We're not there yet. We need to break that out. And on the daily time frame, you see that big divergence? That tells me a pretty good rally is coming, and if and when we break out. And it tells me the breakout's likely based on the divergences that are building. So there you go. That should be net bullish for gold. That's what it looks like on the daily chart. You zoom down to the 60-minute chart, and you can do a comparable trend line right there to what I had on the futures. This is euro US dollar pair right there. There's your divergence as well. Okay, so I remain both near and intermediate term and longer term bullish on gold and the gold mining stocks. I mentioned injective long entry there yesterday as they pull back to support, and again being down today, that just makes them more attractive. And then there's levels I gave you to watch for breakouts and things like that to maybe add to a position. Crude, still one of my favorites for a trend trade, and it's quite profitable already. We had a sell signal back here. We've been stair-stepping lower. And most recently, as of now, I wanted to update. We put in this divergence here on this 60-minute time frame. Last divergence we had right here was positive or bullish divergence, gave us this counter trend rally that we've had over the last few days. But now you can see we're diverging with negative divergence, and that should be the catalyst for the next leg down. I've given you targets on SCO, which is the ETN that you can use for shorting crude by buying that, meaning you go long. It's an inverse ETN 2 times. Or you can look here at the daily chart. I gave you price targets here on this recently. And forget about these divergent high here. They are carrying through from that 60-minute chart, but on the daily, I gave you these trend lines. That was the divergent high right here. That was your divergent high on the daily chart, and then we went on to break this uptrend line right there. Hit that $65 support, back tested the trend line, came down, hit that pretty much that first target, a little shy of it, but again, these are rough targets here on the daily chart. Snap back rally, and I fully expect another leg down soon to this 5680-ish level right there. And that's if and when we get that, let's just say from where we're at right now, you're talking about another 16% downside in crude oil from where we're at right now. And then here's an update on the lumber daily chart. Lumber, as much as it's dropped recently, about 74% correction, but it's still, at this point in time, I believe in a bull trend like all commodities. It is in a bull trend, and until it takes out this previous reaction low, we're still above it right there. Roughly tested it right there on this pullback, but look what we have here. This is the first divergence that we've had, positive divergence on the daily time frame on both indicators in a long time, in fact, since back here. And that was about when crude bottomed. Lumber, of course. That's about when lumber bottomed, had a rally from there. Big rally, if it was well into the double digits, probably almost close to triple digits. Went from, what was that, 280 up to about 4, right here, about 470 or so, roughly, and from there to there. And then here you put in positive divergence on the RSI, and you had you can see big rally there. That was well over 100% rally. Positive divergence on the RSI right there at that low. There you had that big rally there. And now we have positive divergence on both the RSI and the PPO. So that's it. So, very oversold, coming off oversold readings and all that. And then, the one I keep updating is the 30-minute chart here. And that's what it looks like. You had this little wedge pattern here. Let me change the color of this drawing tool. Change that back. There we go. There's a little 30-minute wedge. There's our divergence lines. Moving up, and need to take out this 521.47-ish resistance. That should open the door to any or all of these other targets there. Went through the components of the Dow and some of the S&P 500 top components, and the one that stood out to me, of all the 30 stocks on the Dow, the one that is most bullish to me right now is Intel. So I'm going to pass that along, and after this, I'm about to roll into those indicators and tell you why. Hey. The indicators are serious, giving us some serious red flags, or we'll call them yellow flags at this point because we don't have sell signals on the indexes yet, but we have some pretty ugly divergences and other warning signs, if you will, on the breadth indicators I'm about to get to. But there it is. There's Intel. Intel had a big, divergent high right there, wedge pattern. It was a divergent low here. Intel trades very well to the technicals, and I believe, if I'm not mistaken, all these divergent lows and divergent highs were pointed out. And I just wanted to point out this point in time we have positive divergence. So again, one of the better looking stocks in the Dow. Now, if we get a sell signal in the markets, whether it's, we want to see both the S&P 500 and the NASDAQ 100 give us sell signals. You're probably going to most likely will take Intel down with it. But as long as the music continues, in other words, this game of musical chairs is playing right now, then this one should outperform. And there's a minimum target would be up here. Let me give you one more level right here. You have some resistance it's coming up on right now, about 454.50. If we can pop that, it should run up to about, give or take, that's not a hard level, but about 57.60 or so right there. And again, it's just a matter of how much longer this market can hold up. What I mean by that, I'm going to now roll into the indicators, just show you. But on the weekly charts, these big divergences I've been talking about for quite a while, they continue to build. Negative divergence here, we had it there. So a couple months ago I was talking about it, and it's only gotten bigger. This is the biggest divergence that we've had on the weekly charts of the indexes as well as the many of the top components in a long, long time. We had big, pretty decent, much smaller, but decent negative divergence leading up to that fourth quarter drop in 2018. That was about a close to 20% drop. We had a over 20% drop right there on QQQ back in that little mini crash back in 2015, foreshadowed by divergence. You get the point. And then you can go through all the components. Here's Apple, big negative divergence. Is it in an uptrend? Absolutely. It's in a very strong uptrend, but big divergences. And, I've gone over this chart dozens and dozens of times. These divergences are followed by corrections that typically range well into the double digits, 15 to 20, sometimes 45%, 32, 34, 39, 35, and I'd expect nothing less from these divergences based on the scope of the divergences there. And again, we can go down the line, all of them. Microsoft, Amazon, big divergences. Facebook, big negative divergences. Alphabet, not very big, but it's got some divergences forming now. That's probably one of the strongest looking charts right there. Tesla already peaked out with negative divergence there. That was back in, when was that? Earlier in the year right there. All right, now we're going to roll into those breadth indicators, and they're all, again, all the ones I'm going to cover, and just about every breadth indicator I follow is showing the same thing. The market internals have been deteriorating, and this is one of many charts. This is the NASDAQ composite up top. So up here, let me change colors. Give me a blue arrow. 1 second. There we go. Okay, so you have the NASDAQ composite, I'm sorry, here on the bottom, this line right here, the black line, and this is the NAAD, which is the NASDAQ advanced decline line. And you can see, like everything else, typically the bigger the divergence. This was the divergence leading up into 2008. We had 2006 right there. We had a nice correction back then. That divergence continued to build, big divergence into the Great Bear Market, the Great Recession. The market peaked in 2007, October of 07, bottomed in 09 right there, and that was foreshadowed by the divergence. You can see all the other divergences, and so what you can see on here, I have green arrows. When everything's healthy and hunky-dory, what you see is the NASDAQ advanced decline line should be moving up. You have more stocks advancing than declining, right? It makes sense. However, what happens is towards the tail end, whenever a rally starts to get a little long in the tooth, you see fewer and fewer stocks. Think Apple, Amazon, Microsoft, Facebook, and the big heavy names that have the heaviest weighting and the most beloved stocks. They do most of the heavy lifting, and then you get these divergences. And again, these are all, it doesn't look like much here. You're spanning a couple decades on this chart, but these are the biggest corrections and bear markets, in some cases 20 or near 20% drop. And there was that 36% drop right there into COVID. And yeah, it was foreshadowed by divergence. You had the NASDAQ composite down here making higher highs, and the AD line making lower highs. And there it is now. So you can see off the lows, market was rallying. The number of stocks advancing versus declining was going up as well. But we peaked here, and we've been moving lower. So that's one of many, and I'm going to flip to some other ones here. This one's interesting. This is the NAHL, the NASDAQ New Highs to New Lows Index. So as the name implies, new highs to new lows. And I like to plot it, that's up top. I like to put it a 20-period exponential moving average on it right there. So there's the red line. And so you can probably make out in the video I have these red and green lines, and that is when the two cross. And I also have right here a zoomed in feature. This on the right of the chart over here. This shows you the most recent action zoomed in. And so you can see that the lines cross. They gave me a sell signal there. I also replicated the lines crossing here. You can tweak a MACD as I did here, and it will show you. So forget about it. I'm not using it as a MACD. I'm using it to show this histogram when these lines cross. And so the reason I want to do this video, we just crossed. We have the first cross since, guess when? Right here. right before that big drop last year when COVID hit. That gave us a sell signal, and it came early enough. That red line shows you could have got out right at the top. This was starting to roll over and it crossed, so you were able to, again, had you taken this signal as is, you would have been able to exit longs and or short and profit from that 36% drop or any part of it. And then there are some whipsaws. I have a little notation here. There's no indicator that's perfect. But again, this is the first time that that line has crossed since last March, and that's certainly worth noting. You can see we had a sell signal there. Histogram went down, crossed below the zero line. And that was that near bear market, close to 20% drop in the major indexes, and small caps, other indexes did drop over 20% then. So there it is. It's pretty darn reliable. And again, there are periods where it has some whipsaw signals, but overall, it's signaled and got you out of the market or in shorts early on. And we'll see. Only time will tell if this one proves to be a whipsaw. But what I can tell you, again, there's a lot of other indicators that are flashing some warning signs. We just need some solid sell signals in price. We need this trend to crack. And again, those are the levels I've been watching on the 60-minute charts, the SPY and QQQ lately. That should do the trick. Next up, a completely different type of breadth indicator. Up top here, you have the NAA 200R. That is the percentage of stocks in the NASDAQ composite that are trading above their 200-day moving average. So you can see down here it's a scale. It'll never, the maximum you could ever hit theoretically would be 100%, and lowest would be 0%, meaning all stocks. You're not going to get there. So the range tends to be about 80%. You can see the highs. And now look, everything else, you look for divergence. So divergence is telling you when you have the NASDAQ, which is down below, the NASDAQ composite going up, and you can look for those divergences bullish as well. When the NASDAQ's falling, actually that was falling there. Take that back. Disregard. Okay, let's look at the tops. That's what I have marked here. When you see the percentage of stocks trading above their 200-day falling and the index going up, that's usually when you get corrections. So you had one there. You had divergence here. Well, there's your positive divergence right there. That marked the bottom of the bear market back in the end of the last bear. Well, the previous, before the 36% bear market we had right here. There was positive divergence there, and there was negative divergence. That was a big correction. Negative divergence, big correction. Negative divergence, big correction. No divergence there, but that was that 36% drop. And now look at how steep this divergence. Look at this line falling off, the percentage of stocks trading above their 200-day moving average as the NASDAQ goes to all-time highs. That's telling us something. And again, a lot of these indicators are all saying the same thing. It's, again, fewer and fewer stocks, and they have such a heavy weighting. That's what's going on here. Apple, Microsoft, Amazon, that a lot of the smaller companies are falling, and it's not having an impact on the index just due to their smaller weighting. Okay, this one is the NASI, which is the NASDAQ McClellan Summation Index, right here up top. And down on the bottom, you have the NASDAQ 100. And same thing, you look for these divergences. These divergences right here preceded the market top. That was the top back in October of 2007. The Great Bear Market, Great Recession, we call it. It's 56% or so drop in the markets, S&P 500 and NASDAQ right there. That bear market ended. Then you had a few more signals then. So you had divergence here, big correction back then. Divergence here, long-standing divergence, and that led up to this point. We had two big corrections, two big drops of close to 20% there. In fact, the NASDAQ, well, the QQQ fell over 20% on one of those drops in early 2015 or mid-2015. And this was also a sideways market. It took almost 2 years from when this market peaked back then to take out those previous highs. And again, that was foreshadowed by some pretty big divergences there. Then we had divergence here. That was leading up to that top in 2018. We had a major drop in the fourth quarter of 2018. That was foreshadowed by the divergence on this indicator. Divergence leading right up to that drop almost perfect divergence right up to the drop in the what we call I call the COVID lows. That February to March correction, it was swift but severe, 36% drop in the S&P 500, and again it was foreshadowed by these divergences. So COVID was a catalyst. It got us to where we needed to go, maybe a little faster than we might normally have gotten there, but again it was priced into the technicals. And now the concerning thing, look how steep these divergences are. The span is about equal to these previous ones here and this one, but it's a really sharp drop off in the NASI up here. Again, the Nasdaq McClellan Summation Index, with the market making higher highs, and the NASI just falling off a cliff there lately. This one's the NYUD, which is the NYSE Advanced Decline Volume. Same thing, you look for these divergences down below. This is the NYSE here, and there's the indicator. You get the negative divergence, bear market, or correction, and look at the divergence that we have here. So, thing about divergences, I always say this, one of two things. Number one, they can continue to get bigger for a while, and the bigger they get, typically the bigger the ensuing correction. And sometimes, once in a while, they will get burned through, meaning we could come on, spike back up, take out new highs with the market going on to new highs, and that's certainly a possibility. But again, as I'm going through this, and that's why I'm taking the time to do this, these are a lot of indicators I'm covering, all different types, and they're all saying the same thing. Remember, these are all breadth indicators that I'm talking about here. I'm not even on sentiment indicators right now. They're doing their own, red flags, yellow flags, as they have for a little while now, and that's fine. Sometimes these things build, and then they play out. We'll be looking for those sell signals on the market via breakdowns of support and other things like that. Okay, I had to stop the video there for about 15 minutes or something, so believe my should be picking up here. This is the Nasdaq Advanced Decline line. Again, a lot of the same here. I just want to point that out. This is back in the major market top back in October of 2007. Look at that dropping off the again, the advanced decline. Number of issues advancing versus those declining as the market continued to power higher. I did not use log scale on this one, so it doesn't look like much, but again, this was one of the biggest bear markets in history right there, and 55+% drop right there, so it doesn't look like a lot, but it was. So and again, it was telegraphed by stocks advancing, and again, it took a couple years for that divergence to finally play out. And here was a smaller divergence within the bull market that ensued afterwards, and that foreshadowed or preceded that correction. Divergence, correction. Again, pretty big correction back then too, lasting over a year and a half, almost 2 years before the market recouped the previous highs. And then, of course, that big drop right here. This one also was showing divergence right there into the big drop that we had when COVID hit. And now, this is the first time, we early on in the rally, we had more stocks advancing than declining, as is normally it should be the case in a healthy rally, and it sees divergences. And look at this; it's really fallen off a cliff lately. That's why I wanted to do this video, because I did, I updated these a couple weeks back, maybe a couple months ago, but now we're really seeing these a lot of these indicators drop off, which is again this market internals just showing that the rally, all-time high, prices first and foremost. I get that. But what this is going to tell us, and the takeaway from this is when that a correction is likely coming, and B, it's probably going to be a doozy. Good 20+% would be my guess based on what these indicators are flashing. And then, of course, there's all the wild cards. Everything that's going on politically right now, the COVID, the Delta variant, the Fed tapering, you name it. This market's kind of climbed a wall of worry for a while, but we'll see if those things finally manifest. I've done this long enough to know that everything's hunky-dory until it's not. Bad news doesn't matter until it does. I know that sounds kind of simple, but that's how it works. And yet another one. I told you I have a lot of breadth indicators. There's a lot of them out there, and they're all saying the same thing. This one is the Nasdaq new highs to new lows ratio, and then we're looking at on a weekly time frame. So these are, we're not using candlesticks. I prefer, you want to use line charts on those indicators, and it's the same kind of thing. You look for the divergences. There was some to the left. It's not showing because I'm going back. This chart goes back only 20 years. There were big divergence leading up to that dot-com bubble pop, the big bear market back from 2000 to 2002. Again, you had the divergence leading up to the bear market. It doesn't look like much because I'm not using the log scaling here, but that's your 50+% drop. And again, a little divergences along the way. That's what we look for. And each and every time we had those divergences, it was followed by corrections ranging, at least 10%, and in some cases, 30 to 50% or more in those cases. So there it is. There's your divergence, pretty steep, pretty pronounced, and anything's possible, but I doubt that we're going to burn through these without a correction working its way out, first. And when that comes, again, like I said, we'll have to rely on the charts, looking at price levels, support levels, candlesticks, and all other things like that. Okay, and we're almost finished. 4 more indicators here, and they're really pretty much the same thing. We're going to look at the percentage of stocks trading above their 200-day and above their 50-day moving averages. So this one first, we're going to look at the NASDAQ. So this is the NAA 200R, and that is the percent of stocks in the NASDAQ trading above their 200-day moving average. Simple stuff. You can see my divergence lines. You can see the corrections. These I've measured out. So there's that. In the NASDAQ, it was a 54% drop. I think it was 56, give or take, in the S&P. 19.5, we'll call that 20%, 20%, 13%, 18%, 25%, 30%. That was that drop. Remember, the S&P fell more than the NASDAQ when COVID hit because big tech giants, they actually benefited. Cloud services, Amazon, Microsoft, especially Amazon, some of those others. But here we are. This is the first divergence that we've had since that peak right before the market fell off a cliff in late February into March of last year, and that's it. And look at this. Look how much this indicator is falling off. This is the percentage of stocks trading above their 200-day moving average. Back here, we had it at pretty much as high as it gets. We had about good 80% of stocks trading above their 200-day moving average, just like you had back here. That was early bull market action. And it's just really falling off a cliff. Back there, if you want to say, okay, well, we're coming off a bear market, and this is the first time we're getting ahead of ourselves. Well, we still were hit with a 20% drop there, and then shortly after another 20% drop. Same thing on this one. This is the 50-day percentage of stocks trading above their 50-day moving average. Back here, we hit a multi-decade, maybe even an all-time high of about 90%. And that had to do with the snapback. You had a lot of stocks fall hard into the drop. And here I have it measured out as 30%. Again, these are rough estimates. I just grabbed these little measuring tools. And that's it. So this is it. We've been powering higher in the markets, yet fewer and fewer stocks are trading above their 50-day moving average. And in fact, as of now, we only have about 39% of stocks, less than half, trading above their 50-day moving average. And you could see it just falling off a cliff there. So it would be quite unusual if this is not followed by a correction. And from the scope of those previous divergences, we're right on track. This is about as big as it usually gets before a correction sets in. Finally, a lot of these indicators I was covering the NASDAQ. We'll look at the S&P as well. Let me give you another one. Okay, there it is. This is percentage of stocks trading above their 50-day moving average in the S&P 500, and same thing. So that's it. I know it's a lot of the same, but as I always say, the more evidence you have to support a bullish or bearish case, the better your chances you're going to get that reversal. And these are indicators. These show market conditions. And this shows you right here, sometimes you start diverging and you diverge and you keep diverging, and it takes a while, and then it finally plays out. And sometimes it's a smaller divergence, and then you get a correction. So there's no way to say with certainty when the correction or the next bear market or correction will come, or how deep it'll be. But again, if nothing else, it's a red flag on the market. And then last but not least, that was the 50. There's the S&P 500 on the 200-day moving average. Same story there. So, like I said, just about all my breadth indicators are flashing these warning signs. All right, let's wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.